This is Macro Horizons, episode 327, CPI versus Supply, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of June 9th. And as we look forward to the combination of CPI and the 10-year auction on Wednesday, we're reminded that there's no such thing as a bad bond, just a bad price and bad strategists. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market saw the tone set by the fundamentals. Here we had the payrolls report combined with the ISM series. We did get the beige book, and all of this points to a specific set of risks as the market continues to digest the incoming information as well as the ongoing headlines out of Washington. Taking a step back, we remain constructive on the Treasury market, and we expect that as we move further into the year, we will see some of the more traditional influences start to take hold in the Treasury market. This implies that once the peak reflation risk has been priced in, eventually we'll see a drift lower in break-evens and inflation expectations further out. And this should serve to limit any potential backup in rates. That being said, there will be bond bearish moments, clearly. However, those moments are more likely than not to be contained within the known trading range. We're less concerned about a wholesale repricing to a higher rate plateau, and more concerned that the market has underpriced the potential for a major economic shock of some type. Now, over the next month and a half, the Treasury market will test the traditional bond bullish seasonals. Typically, the summer months tend to be characterized by a drift lower in rates, and it will be interesting to see if that once again comes to fruition. With that as a backdrop, the market will be contemplating the extent to which it should be trading realized inflation, specifically in the form of May's CPI, which does occur the morning of the 10-year auction. So there will be the back and forth between the realized data and supply. We also have our continued concerns about the need for the Treasury Department to increase borrowing, although the borrowing increases are unlikely to be seen until 2026. Recall that in the most recent refunding statement, the Treasury Department chose to retain the several quarters language, which we're equating to at least 3 quarters, which puts us solidly into 2026. Now, Besant has already outlined the fact that any increase in borrowing will come in the form of larger bill auctions, which, frankly, the market will have no problem absorbing in the current environment. It will nonetheless be interesting to see how willing the Treasury market will be to retrade the same narrative once we start to see headlines from the Senate and the potential for the timing and the details of such a deal. If nothing else, the market is faced with especially interesting political times.
Well, May's NFP data is in hand, and we also have ISM services, ADP, JOLTS, and all the other fundamental economic information that is associated with the first week of the month. This sets the stage for the Fed in a couple weeks, with, of course, the acknowledgement that next week's CPI print is going to be an event risk to consider between now and then. And really the question has become Powell's interpretation of the balance of risks between the inflation and employment sides of the dual mandate, now that we have some sense of the fallout of tariffs and how the broader uncertainty is impacting the economy. And while our baseline operating assumption is that there has not been enough of a change in the trajectory of the economy to shift from the wait-and-see stance, there is at least the risk that the first half of 2025 will necessitate a bit of a recalibration in terms of the Fed's messaging around the timing of the next rate move. Obviously, the path of least resistance is that that move is going to be a cut, but there are surely some in the market that continue to question whether another cut of any magnitude is warranted from the Fed at all.
And that does set up the balance of 2025 to be a particularly interesting period for monetary policy. We've seen fluctuations in risk assets as well as the rise and fall and rise again of rates. And for all intents and purposes, the U.S. economy appears to be on solid footing, all things considered. Putting this in the context of future rate cuts, it is important to keep in mind that from the perspective of monetary policymakers, there's a big difference between removing restriction and easing policy. 2 more quarter-point cuts in 2025 would be taking monetary policy from restrictive to less restrictive. It certainly wouldn't risk pushing up against anyone's definition of neutral. One of the reasons that the market is assuming that rate cuts will be the path of least resistance is because it's simply the removal of restriction. Now, that also implies that we don't need to see a breakdown of the U.S. economy to justify rate cuts. Instead, simply a moving forward of compressed realized inflation and forward inflation expectations would, in a normal environment, be sufficient in and of itself. However, given the reflationary risks posed by the trade war, simply delaying rate cuts in response to the uncertainty seems to be the Fed's default position. That is, of course, unless and until something breaks, whether that comes in the form of the equity market or the labor market or a credit event, that remains to be seen. But we've certainly been impressed with the resilience of the U.S. economy thus far, especially given what trade war uncertainty has done for the ability of decision makers to move forward with hiring, with new projects, with investment.
We've also heard the argument made that there's been a lot of easing that's been going on in other forms, aside from specifically Fed rate cuts, that's taking more and more of the pressure off Powell to actually need to start cutting rates again as soon as September or December. Obviously, other major central banks have delivered more easing than the Fed has, not to mention the fact that risk assets broadly, which have now recovered entirely from their Liberation Day move lower, all points to various forms of easing financial conditions. Now, one of the main things going wrong that could necessitate the Fed reacting dovishly sooner rather than later would be a large and fast tightening of financial conditions. That could come from a sharp drop in stocks, from a credit event, as you touched on, Ian, but for the time being, the risks of either of those seem relatively low. Part of that has to do with the fact that we've already gotten 100 basis points of cuts from the Fed, combined with lower rates globally, and while those moves weren't framed as preemptive to get monetary policy away from its formerly extremely restrictive levels, it's now starting to increasingly look like that maybe that's exactly what played out. The consistent refrain from the Fed has been that monetary policy is in a good place, and as long as the labor market remains solid and financial conditions stay orderly, frankly, there's very little incentive for the Fed to do much of anything.
One of the bigger risks that we've been contemplating, at least for the consumer, is the fact that for the first time in history, we're seeing mortgage interest expenses and non-mortgage interest expenses be effectively the same. So we know what has happened. During the pandemic, many households were able to lock in extremely low mortgage rates. And post-pandemic, as interest rates began to rise, we saw higher interest paid for credit cards, auto loans, student loans, etc. The question then quickly becomes, can the bottom 2 quartiles of consumers withstand another material increase in realized prices? It's not difficult to envision a scenario in which we see nominal spending increase slightly, but inflation outpaced the increase, which would result in a decline in real consumption. Now, currently, that's an underpriced risk, as the market doesn't anticipate this will be the outcome. But given the lack of clarity on tariffs and what one should expect from the realized data, it's a risk that we'll keep on the radar over the course of the summer. Now, shifting gears slightly, it's important to keep in mind that the market is still on guard for evidence of a buyer's strike in treasuries. The upcoming auctions will provide yet another litmus test of demand for treasuries at these levels. We'll be focused on the $39 billion 10-year as well as the $22 billion 30-year on Thursday. All else being equal, we're anticipating yet another solid showing for demand, and suspect that any rotation away from dollar assets as a store of reserves will be gradual and play out over the course of years, not months.
And that rotation argument, and around Liberation Day, what was the frequent discussion around the potential for global investors to shun treasuries entirely, has now given way to the discussion of if there is a rotation out of treasuries into EGBs or JGBs or gilts, what is that actually worth in terms of the level of 10-year yields? To look at auction performance, with May's 2s, 5s, and 7s as the most recent example, there's at least a degree of that rotation discount already incorporated with yields at current levels. Clearly, the strength of those auctions, that all came at effectively the low yield marks of the day, with the 7-year at the end of May showing the highest non-dealer allocation of any nominal auction ever. Yields have clearly reached levels, at least in the front end and belly of the curve, that is sufficient to bring in strong end-user demand. Now, we can't yet know specifically whether those auctions were a function of foreign or domestic sponsorship, but the broad-based strength shows a depth of demand that adds for the dip buying case, particularly with yields back at these levels.
We'll add that the primary driver of a buyer's strike was thought to be the trade war and stepping back from the Treasury market in the attempt to demonstrate the relevance of buying at auction. Now, it strikes us that the opposite argument might be true, and that is, why would one preemptively pull back from the Treasury market rather than demonstrating ongoing sponsorship for Treasuries as a negotiating tool? As we've noted, we have yet to see any clear evidence of foreign sponsorship pulling back from treasuries, but it has and it will continue to remain a very topical concern and an ongoing angst for treasury investors.
And along with the bid that comes to meet 10s and 30s this upcoming week, it's also difficult to overstate the relevance of CPI, especially given what we saw with last month's softer read, and at least some marginal optimism that the disinflationary trend is durable. Now, May's data in isolation is not going to definitively decide one way or another if the Fed has more credibility in declaring victory over inflation, but critically as an input to the inflation picture during a month when trade war uncertainty and tariff volatility was in full swing, it's going to be telling to see how that flowed through to end users and consumer prices, which obviously is going to be top of mind for the Fed and the market as the forward path of policy rate assumptions are refined.
Eventually, the Fed will need to begin resuming the process of normalization. It's also worth keeping in mind that come the middle of May of 2026, Powell will presumably no longer be the Fed chair. And it's also a reasonably safe assumption that the incoming Fed chair, whether that's Warsh or Waller or whoever ultimately ends up getting the nomination and the confirmation, will be less hawkish than Powell and the Fed currently appears to be. So if nothing else, that means that there's a shelf life to how long the Fed can delay rate cuts. Even if we don't get rate cuts in 2025, the market is right to assume that they will begin in earnest next year.
I just want to know what the Lyngen Fed is going to do.
I would assume pretty much the same thing as the Jeffrey Fed.
What we do every day. Nothing.
In the week ahead, the market will continue to digest the recent developments as well as the results of the May payrolls report. With this backdrop, the Treasury market is tasked with taking down the three major coupon auctions. On Tuesday, we start with 58 billion 3 years, followed by 39 billion 10 years on Wednesday, and capped with 22 billion long bonds on Thursday. Wednesday's price action will presumably be the most interesting, given that in the morning, the market gets its first look at May's inflation numbers via the CPI report. Expectations are for a 0.2% increase in headline CPI, which from a broader perspective is very moderate overall. Expectations are also for core CPI to print at 0.3, very much in keeping with the Fed's objective and the fact that inflation has yet to materially accelerate as a function of the trade war. Now, there is clearly a bias towards the upside within the data as the market continues to look for any indication that increased tariffs and levies have finally made it through to the realized data. Keep in mind that on Thursday, we also see PPI, both headline and core for the month of May, and that will serve to all but solidify expectations for core PCE in the month of May. Looking back at the last 2 months, both core PCE in March and April printed at 0.1%, So another benign read in May would be very consistent with the Fed's 2% objective, and in a more typical environment would lead market participants to the conclusion that it's time to begin lowering rates. However, Trump and the trade war have left the economy in anything but a normal or typical environment. So it's with this backdrop that we expect that the Fed will remain on hold for the foreseeable future. And in financial markets, the foreseeable future translates through to at least the next couple Fed meetings. Should September be a live meeting? That's a debate that will have the inputs of the most recent inflation series, as well as what we learned from the FOMC on the 18th via the updated dot plot. And as always, the Treasury market will be closely focused on the response in risk assets to the recent developments, and there remains a risk that there's an overinterpretation of any slight weakness at the 10 or 30-year auctions. All else being equal, we expect that the auctions will be reasonably well received, with a nod to the fact that the combination of the outright level of yields as well as the uncertainty could result in Wednesday's 10-year auction being a particular wild card for the outlook. We've reached a point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we look cautiously towards the upcoming Friday the 13th, we'll make the observation that there is only one in 2025 compared to 2 in 2024 and 3 in 2026. Either it's a luckier year or the bad luck has simply been consolidated into Friday. Either way, we're taking the day off. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.